The principle that income can be derived from lending money to another person and getting the money back after some period of time with a surplus has been an essential part of our daily lives for centuries. The whole global economic infrastructure is built around interest on loans. Interest on a loan shall be paid irrespective of whether the lender or a venture for which the money was given has been successful or not. That means that a person can make money out of the mere fact that he has money and another person doesn't. This leads to the outcome where the rich get richer while the poor get poorer. Even in the difficult financial times, the debtor is obliged to return the loan and pay the interest. Although this system where money per se is considered as a commodity seems natural to us, another financial system with its own principles and where money is just the medium to buy or sell the commodity has been established since the second half of the 20th century. Firstly, it appeared in the Islamic countries only, but gradually reached the Western world, and now London and Luxembourg, along with Dubai, Abu Dhabi, Bahrain and Kuala Lumpur, can be considered as the centers of the Islamic financial system. Interesting to note that despite its name, Islamic banking is not religious banking or mere charity. It has the same goal as to satisfy the economic needs of individuals, companies and society as a whole, but according to certain principles which are derived from Islamic teachings. So, how large is the Islamic banking and finance? Although Islamic finance is a relatively small player in global terms, most analysts agree that the market size of assets held in Islamic financial institutions is between 1.7 trillion to 2.1 trillion US dollars. It has been growing in the last decades at a rate of between 15 to 20% and shows no sign of reducing in the short to medium term. This continued growth has been supported by the actions of many governments around the world, including the UK, Germany and the USA, keen to see the development of these alternative financial mechanisms. Nowadays, there are more than 300 Islamic banks and so-called Islamic financial windows, as well as 250 Sharia-compliant mutual funds that are present in at least 60 countries. The growth of Islamic funds worldwide has been supported by the launch of several Islamic indices by prominent providers over the past few years. The first was the Dow Jones Islamic Market Index, launched in 1999, followed by the FTSE Global Islamic Index series the same year, and in 2006 by the Standard & Poor's Sharia indices. So, how is the Islamic finance different from the traditional banking and financial system? Islamic finance is in some ways similar to the traditional financial system, yet it uses different mechanisms which in difficult financial times prove to be more viable in comparison to conventional banking. Firstly, money is considered to be the medium only and not the commodity per se. As such, all assets in Islamic finance should be backed up by tangible assets such as property, land or share in business. Secondly, you cannot derive money just from lending it to another person or entity. In Islamic finance, the person who gives money usually becomes a partner and shares the profits or possible losses. Finally, Islamic financial system is strongly connected with ethical component. Ventures which are related to gambling, alcohol, and those that bear a high degree of uncertainty are not eligible for financing. We are going to learn about these and some other fundamental differences in the following lectures, and will discuss the most common modes of Islamic finances in more detail. Modern-day Islamic finance emerged in the 1960s with the establishment of the first Islamic bank in Egypt by Ahmad al-Najjar and the setup of Lembaga Tabung Haji in Malaysia, which mostly dealt with investments of funds into Sharia-compliant ventures and businesses. However, the real origins of Islamic financial mechanisms date back to the Prophet Muhammad and the early years of Islamic civilization in 7th century AD. At that time, trading was very popular and Prophet Muhammad himself used to carry goods from Mecca to neighboring regions in caravans. These caravans were assembled on a partnership basis with other merchants. Since that time, trading and partnership have been one of the pillars of the Islamic economy. Another source of income for early Muslims was agriculture. They used forward contracts in which they agreed on the prices, volume, and quality of goods which were to be delivered after 1 or 2 years. Today, this form of contract is still widely used in both Islamic world and Western countries. They are known as Bayus Salam. Islamic contract in which full payment is made in advance for specific goods, often agricultural products, which are to be delivered at a future date. Starting from the 8th century and onwards, the Islamic civilization developed a number of financial instruments such as promissory notes, checks, hawala, and trusts. However, until the 1970s, Islamic banking was mostly focused on the retail market. There were partnership agreements between separate individuals or companies, but there hardly was any global interconnected system of Islamic banking and finance which was governed by harmonized rules and which provided the amplitude of various financial instruments for public and enterprises. Islamic finance started to develop much more actively with the oil crisis in the late 1970s. It was the time of increasing oil prices and as a result lots of capital coming to oil-producing countries, especially in the Middle East. In 1975, more than 50 countries established the Islamic Development Bank, aimed at providing funding to projects in the member countries and Muslim communities around the world. As of 2017, IDB comprises of 57 member countries and its total assets are approximately $24 billion and authorized capital is more than $134 billion. It supports infrastructural projects worth billions of dollars as well as provides financial assistance in other areas, including education, healthcare, and so on. The first modern commercial Islamic bank, Dubai Islamic Bank, was established in 1979. In the same year, the first Islamic insurance or Takaful company, the Islamic Insurance Company of Sudan, was set up. In year 1990, the first Islamic alternative to conventional bonds, Sukuk, were issued by Shell MDS in Malaysia, which meant the emergence of Islamic bond market where bonds could be traded. Sukuk instrument immediately became very popular in Islamic countries, both among sovereign and corporate issuers. These days, Sukuk is issued for billions of dollars every year, not only in Islamic countries, but also in the Western world. The large US-based Citibank began to offer Islamic banking services in 1996, when it established the Citi Islamic Investment Bank in Bahrain. The first Islamic commercial bank outside the Muslim world was established in Britain in 2004 and was called the Islamic Bank of Britain. Significant efforts have also been made to harmonize Islamic financial products and services. These efforts include creating accounting standards for Islamic financial products for the Accounting and Auditing Organization for Islamic Financial Institution, known as IOFI, which was set up in 1990, and integration of those standards with global corporate risk management standards, which is Basel Accord 1, 2, and 3, through the Islamic Financial Services Board, established in 2002. The International Monetary Fund, IMF, and the World Bank have also recently included Islamic finance under their scope of activities. Finally, the creation of Islamic market indices in 1999 and 2006 by Dow Jones, FTSE, and Standard & Poor's marked that there was now authoritative benchmarks, and many Islamic investment funds appeared slightly after that, ready to invest their abundant capital into Sharia-compliant international businesses. In the years 2008-2009, amidst growing global financial crisis, Islamic banks were reported not to be initially impacted, since they didn't have on their balance sheets any so-called toxic assets which were not Sharia-compliant. However, after some time, Islamic financial institutions were also hurt, as the global financial crisis also led to the sharp decrease in valuation of real estate and private equity, the two segments which Islamic companies used to invest in. Today, Islamic finance represents a small but growing segment of the global finance industry, estimated at 1 to 2% of the global financial assets worldwide. It grows at an annual rate of 15 to 20%, and the forecast for the industry is mostly positive. There are more than 300 Islamic banks and so-called Islamic financial windows, as well as additionally over 250 Sharia-compliant mutual funds that are present in at least 60 countries. Nowadays, Islamic finance is still little known among wider population, especially in the Western countries. However, there is a number of Western multinational financial institutions which have already started offering Islamic financial products in the international Islamic financial market. Quite recently, Islamic finance has seen some sophisticated financial product innovations, which proves that it is developing steadily and there is a growing market. In the next lectures, we are going to dive deep into the specific financial instruments which are used today in Islamic banks. Islamic finance is a term that reflects financial business that is not contradictory to the principles of the Sharia. The Sharia is a framework of Islamic law which is based on the following primary sources: the Quran and the teachings of the Prophet Muhammad. The latter is known as Sunnah. In addition to these primary sources, there is dynamic secondary source of common law rulings and scholarly interpretations, which are known as fatwas. Fatwas represent the rulings of scholars concerning certain issues, including economic ones. Fatwas represent how Islamic law can exist along with the new realities in the world and new economic framework. Thus, Sharia combines both solid fundamental principles, such as those in Quran and Sunnah, as well as dynamic rulings known as fatwas, which try to bring together the fundamental principles and contemporary social and economic realities. Based on this legal Sharia framework, early Islamic scholars developed key principles which would become the keystone for the further growth of Islamic finance and economy. First and probably the central tenet of Islamic finance is the prohibition of usury. There is a specific Arabic term which refers to usury, and it is called riba. Riba is any unjustified increase of capital in the loan. It means that any guaranteed increase in the amount of principal connected to the maturity or due date, regardless the performance of the investment, is considered as riba and is strictly prohibited. It means that if the loan is given to the debtor and it is stated that he will have to return the loan with the surplus, not depending on whether the purpose for which he has taken the loan has been successful or not, will be regarded as riba or usury contract. Thus, this key principle of prohibition of riba is that it encourages profits only as a result of successful activities, which result in the formation of a final product or service and not from merely lending the money. Second key principle of Islamic finance is sharing of risks and profits. Since Islamic finance prohibits interest, capital lender is not a mere lender of money, but rather an investor in the common venture who shares the risk that the venture may not be successful. So he doesn't have the guarantee of regular income and will only get his share of profit in case the project is successful. That's why in Islamic finance, the due diligence of the project is performed more accurately than in conventional banking system, since the investor is truly interested in this project becoming profitable after he provides necessary investments. Another term that is worth understanding when dealing with Islamic finance is the concept of gharar. Gharar in Arabic is anything which is connected with uncertainty, and it is also prohibited in financial operations. In financial context, gharar refers to the sale of items whose existence is not certain. For example, buying insurance premiums to insure against some form of event which may or may not happen, or purchasing derivatives used to hedge against possible outcomes. These two examples will fall under the concept of gharar, and they cannot be used in Islamic finance. In conventional financial system, derivative financial instruments are widely used, but since they have significant risk level, they lead to rapid development of speculation in the financial market. By prohibiting these risky instruments, Islamic finance stands as a conservative market area, but at the same time ensures the long-term stability of the system. Since Islamic finance is based on Sharia, it also prohibits any financial transactions which relate to any product or service or activity which do not comply with Sharia. In this way, operations with such products as alcohol, pork, arms, gambling are not within the scope of Islamic finance. When Islamic banks want to invest into a venture or an existing company, they consult their Sharia councils, which is a special obligatory department in each Islamic financial institution. These Sharia councils will analyze the business and decide if investing into the venture will comply with the Sharia principles. So, Islamic institutions sometimes do face certain challenges when investing in such activities as hospitality and entertainment industry. So, these are the main terms and principles which are used in Islamic finance. They are the cornerstone of every Islamic financial institution and of the industry as a whole. Based on these key principles, Islamic scholars and economists have developed over the years a number of financial products which both comply with the Sharia principles and satisfy the economic needs of individuals, businesses, and the state. We are going to learn about these products in the upcoming lectures. The first financing instrument which can be often encountered in Islamic finance is mudaraba. It is also called profit and loss sharing contract. Mudaraba was one of financial mechanisms that was quite popular in the Middle Ages. It was even used before Islam to finance caravan trade in Arabian Peninsula. It was later approved by Islamic scholars as legal means of financing, since even the Prophet Muhammad used mudaraba modes of transactions. Similar to mudaraba mechanisms were also used in medieval Europe, especially by Venice merchants in 11th century and onwards to carry goods for trade. Such contracts were known as commenda. Mudaraba contracts are similar to trust-based financing in conventional financial system. In this arrangement, the Islamic bank pools the money of different investors together and invests them, for example, in a Sharia-compliant mutual fund or another venture or business. The income which is generated from the invested money is distributed between the investors and the bank. The ratio at which this income is divided between the bank and investors is usually set up in the agreement which the parties sign prior to signing the mudaraba contract. The bank is entitled to the profit because it manages the whole investment process, including choosing the funds, due diligence, and so on. In mudaraba arrangements, investors are called Rab al-Mal, that is the owners of the capital, while the bank is called mudarib or agent, which means the person or the party managing the capital or the trustee in conventional terminology. According to mudaraba agreements, as we mentioned, in case there is profit, it is distributed at a ratio agreed upon by mutual consent. However, in case of loss, only Rab al-Mal, that is the investor, bears the capital loss, and mudarib or the bank or the agent bears loss of getting nothing for his expended time, efforts, and labor. However, in modern times, since the banks diversify their assets, provide due diligence, and since they are interested in maintaining and growing their customer and investor base, it is highly unlikely that investors will lose their money or there will be a significant loss in their investments. And of course, if the loss was caused by the mudaribs or the bank's negligence, then in this case the bank will take the responsibility for the loss as well in terms of money. Mudaraba contracts are divided into two main types: restricted mudaraba and unrestricted mudaraba. In restricted mudaraba, the mudarib or the bank is limited in his actions by certain terms and conditions agreed before with Rab al-Mal. And in unrestricted mudaraba, mudarib or the bank is free to conduct the project and invest money as he sees fit. Nowadays, Islamic banks use mudaraba as their key instrument of investment deposits. As an investment deposit, mudaraba allows its investors or depositors to get some return on their investments. However, unlike conventional banking and ordinary saving deposits in traditional banks where there is a fixed interest rate, Islamic banks pay the return in form of proportion of profit share. It might seem that it will be difficult for the investor to know what amount of return to expect from the Islamic bank. However, Islamic banks give the average rate of their profitability on investments, and since this rate is based on previous years and they have a diversified portfolio of investments, and the bank wants to keep the customer base and increase it, as a rule the investor gets the return that the bank had promised him and that he expected. So how does the scheme of mudaraba look like? First, the customer deposits his funds to an Islamic bank under mudaraba agreement. Then the bank uses the funds to invest in Sharia-compliant businesses to generate profit. These businesses generate positive or negative profits, although negative scenarios are very rare. Positive profits are shared between depositor and bank at a pre-agreed ratio. If there are any negative profits, then they are represented as the decline of the asset created with its investments and the value of deposit is decreased. Actually, when we say that the bank invests assets of its depositors into some business or venture, the bank also acts as Rabul Mal, or the owner of the funds. That's why the mudaraba scheme, which is used these days by Islamic financial institutions, is also known as a two-tier mudaraba. On the one hand, the Islamic bank receives deposits as an agent or mudarib of its customers, and on the other hand, the Islamic bank provides financing to its clients who come to the bank to request financing. In this case, the bank acts as Rabul Mal, or sleeping partner. This is what is called two-tier mudaraba, and it is common for most Islamic banks these days. So, to wrap up, mudaraba is one of the most widely used mechanisms used by Islamic financial institutions. It is based on profit and loss sharing between the bank and the customer. Unlike conventional banking system, instead of a fixed interest on the investment, the bank provides share of the profits. Thus, the Islamic banking system runs on profit and loss sharing mechanism and stays away from the interest-based schemes. Musharaka comes from the Arabic word sharika, which means partnership. In modern financial terms, musharaka means a joint venture of the Islamic financial institution and the entrepreneur where both parties share profits and losses. It is quite similar to mudaraba, but unlike mudaraba, where only one partner invests money and the other partner invests his time and efforts to manage this investment, in musharaka scheme, both parties are funding the project together. Profits and losses are divided in proportion to the participation of the parties in the financing, so the partners do not necessarily have equal participation in the project. The project may have more than two partners and can be managed by all participants or by one of them. In this case, the managing participant can receive a bigger share of profits for his additional work responsibilities. These days, musharaka contracts are often used in business settings to provide additional working capital for the company or for joint investments, for example in real estate or agriculture. In consumer financing, musharaka contracts are often used to finance the purchase of home, for example. In this case, the bank and the family purchase the home jointly, but over time the bank gradually transfers its portion of the equity of the home to the customer, who in return makes installment payments to the bank to purchase these portions. This is also known as diminishing musharaka, which ends up with the complete ownership of an asset by one partner. In case of home purchasing, that would be an individual or a family. Another very popular mode of financing in Islamic banking is called murabaha. In common terms, it can be called cost plus sale. Sale agreements existed long before Islamic civilization, and Islamic financial system uses them very widely, since debt-based instruments and products cannot be properly acquired. Today, about 70 to 80% of all transactions in Islamic finance are based on murabaha contracts. In murabaha arrangement, on behalf of the client, the bank purchases a house, a car, some equipment or raw materials with free and clear title to it. Then the bank agrees to resell this product to the buyer who needs this product. For the bank to make profit, the price for the buyer includes a certain markup for bank services. The purchase of the product from the bank can be arranged as a full lump sum or via the installments or deferred payments. The price of the goods is determined in advance and specifies the markup or the reward of the bank for the services rendered. From the outer perspective, it looks similar to the ordinary loan from a conventional bank to buy a house or a car, but in fact it's different. In the case with the conventional banking, the bank lends the money. The principal, together with interest, are subject of the loan contract between the bank and the borrower. In contrast, in Islamic banking, the bank becomes the rightful owner of the product, which the bank later sells to the client. And therefore, the subject of the contract is a product or an asset, and it is the contract of sale and not the loan contract. This is the main difference between the conventional banking and Islamic banking, as sales are allowed in Islam and interest-bearing loans are prohibited. The other difference is that Islamic financial institutions bear more risks than conventional banks, because before the goods are received by the customer, the Islamic banks bears all risks associated with possible damage to the goods, since after initial purchase the bank becomes the rightful owner of the goods. So, if we go deeper into the murabaha contract, under this contract a three-party arrangement is made where the customer places an order with the financial institution to purchase goods from a supplier. The customer may pay a security deposit with the financial institution, and the amount of financing outstanding can be secured either in the form of collateral or guarantee. The financial institution, having purchased the goods from the supplier, then sells them to the customer at a price including markup with a fixed credit period. So let's look into the murabaha step-by-step scheme. First, buyer and seller agree on goods to be purchased. Second, buyer requests Islamic bank to purchase the goods and promises to purchase goods from Islamic bank as soon as the goods have been purchased by the bank from the seller. Next, Islamic bank purchases specified goods from seller. Then the seller delivers goods to Islamic bank. At this stage, buyer is usually appointed as agent of Islamic bank to inspect and accept goods and their quality. Once the buyer accepts the goods, the Islamic bank pays the seller for the goods. Now the Islamic bank resells these goods to the buyer, and his price includes the bank's profit, which was agreed in advance between the buyer and the bank. On the final stage, the buyer pays for goods on payment terms agreed by buyer and Islamic bank. It can be a lump sum or deferred installments. Another mode of financing which is often used by Islamic financial institutions is called ijara. Ijara is similar to leasing transaction in conventional financial system. In ijara arrangement, Islamic financial institution purchases equipment, property, house or a car at the customer's request and then rents it to the customer who pays regular fees for leasing. The duration of the lease and rent fee is agreed by the parties before they conclude the agreement. There is a variation of ijara contract which is called ijara wa iktina, and according to this contract the lessor agrees to sell the leased object at the end of the lease term at a predetermined residual value. Unlike conventional banking, where both parties might be usually bound by this agreement, in Islamic banking only the lessor is bound by this promise and the lessee is not obliged to purchase the item at the end of the lease term. This is done because in Islamic finance, two contracts cannot be concluded between two parties at the same time regarding the same subject of the contract. So let's take two examples. One example between Islamic bank and individual, and one example between the bank and the company. If you as an individual want to purchase a home, for instance, you will request the Islamic bank to purchase it for you and after the purchase to lease it for you for a certain period of time. You will normally conclude ijara wa iktina contract, which means that after the lease term you will buy the home at a predetermined residual value. How is it different from a conventional mortgage contract? Well, in a mortgage contract, the subject of the contract is again a loan with interest. The bank doesn't own the property which you buy using the mortgage will act as a collateral to your loan. In the case with Islamic bank, the bank will buy the property and lease it to you. So the bank bears the possible risks of ownership connected with this property. Now the second example. If a company wants to get financing from the Islamic bank. If the company has any property or tangible assets of its own, they will sell these assets to the Islamic bank with the right to repurchase them at the end of the ijara term. Then the company will start leasing this property or the asset from the bank, and by the end of the lease term they will get back the full share of ownership. The lease rate will of course include the markup of the bank, so that the Islamic bank will make profit while the client will get the necessary financing as a lump sum and then will repay this financing during an agreed period of time, after which it will regain the full ownership rights. Another popular mode of financing in Islamic finance is the contract of salam. This is a forward contract where the buyer or an Islamic financial institution on behalf of the buyer pays for goods in full in advance and the goods are delivered to the buyer at an agreed time in the future. Salam was known on the Arabic Peninsula in pre-Islamic times and it was also approved by Islam on certain conditions. In the past, the idea behind salam contract was that poor peasants usually didn't have enough money to pay for their needs, and salam contracts made it possible for them to get money before their crops were grown. That's why salam contracts were also known as contracts for the poor and the needy. At the same time, the buyers also found these contracts profitable, as the price for the goods was usually lower in salam contracts in comparison to ordinary contracts where the goods were delivered immediately after the signing of the contract. These days, this mode of financing is usually used to finance the cost of manufacturing of a product or construction of a building, or to finance farmers to produce the agricultural products. Since the payment is done in advance, before the product is manufactured, the producer uses the money as working capital to purchase raw materials and pay salary. In order for salam contract to be valid, it shall abide by some rules. First, the buyer must pay the full amount of price at the time of effecting the sale. This is required because if there is no full payment at the moment of contract signature, it means that there is a sale of debt in form of goods against debt in form of money, which is prohibited by Sharia. Second, the goods or commodities should be specified and described both in quantity and quality, so that there is no dispute between the buyer and the seller when the goods are delivered. Things that cannot be specified in quality and quantity cannot be covered by salam contract. Third, the delivery date and the place of delivery shall be specified since they affect the price. Finally, salam contracts cannot be used to sell the things which must be sold at spot according to the Sharia. This includes sale of money or gold and silver. In salam contract, the buyer may ask the seller to furnish a security to ensure that the goods will be delivered. The security can be in the form of guarantee or in the form of mortgage. Salam contracts are often compared to future contracts in conventional financial system. They are indeed similar, but nonetheless have slight differences. First, in salam contracts, the commodity cannot be resold until it is delivered to the buyer after it is produced. On the contrary, in conventional futures markets, reselling of goods which are not produced yet under future contracts is allowed. Moreover, these days in conventional financial system, futures markets are even separated from the commodity markets, which makes it more vulnerable in comparison to salam contracts. Secondly, in conventional future markets, full advance payment is not required, whereas in salam contract, the buyer must pay the full price in advance. There is a variation of salam contract these days, which is called parallel salam. In parallel salam, the buyer who has just purchased commodity under one salam contract enters into a second salam contract with another party to supply the same commodity at a future date. This mechanism allows the buyer to recover his investment, hedge against the price risk, and even make some profit. For the parallel salam contract to be valid, the two contracts should be separate and independent of each other. In the first contract, the financier is the buyer, and in the second contract, the financier is the seller. The performance of two contracts shall not be contingent on each other. Parallel salam is only allowed with a third independent party. The seller in the first salam contract cannot be the purchaser in the parallel salam contract, because it will be equivalent to the buyback contract, which is often used in conventional financing and which is prohibited in Islamic finance. So that's it about salam contracts. See you in the next lectures. If you follow global financial markets, then you have probably heard about a relatively new financial term or product, which is called sukuk. Sukuk was first issued in Malaysia in 2000, and since then they have become important Islamic financial instrument in raising funds for long-term project financing. In fact, the use of sukuk around the world has been growing at an enormous rate from $15 billion in 2008 to $350 billion in the year 2017. And it still has a huge potential for growth, as it is still considered a niche market. So, what is sukuk? Sukuk comes from the Arabic word sak, which means certificate. In modern financial terms, sukuk is commonly known as the Islamic equivalent of bonds. According to IOFI, International Organization for Islamic Financial Institutions, sukuk are certificates of equal value representing undivided shares in the ownership of tangible assets, use of rights and services, or in the ownership of the assets of particular projects or special investment activity. Unlike conventional bonds, which confirm the ownership of a debt, sukuk confirm that the investor owns a share of an asset along with proportionate profit cash flow as well as risk. This scheme is fully compatible with Sharia, because as we know it is based on profit and risk sharing and doesn't deal with interest on a debt. Nowadays, sukuk instruments are very important in developing global finance, as they connect issuers, primarily governments and corporations from the Middle East and Southeast Asia, with a wide pool of investors who seek to diversify their portfolios. The sukuk assets may include facilities such as roads or bridges, real estate, operating businesses, and equipment, to name but a few, which are owned by the sukuk investors until the sukuk maturity date. So, how does sukuk issuance work? The typical example, which is also used these days by famous international airlines such as Emirates, Dubai Airlines, Etihad, is when the airline purchases some tangible assets such as planes and places them into a trust. Then it sells these planes to a pool of investors via sukuk certificates. As owners of the planes, investors receive the profits based on the profitability of the asset. When the sukuk has come to the maturity date, the airline repurchases the plane from the investors. From the outer perspective, Sukuk certificate may seem similar to conventional bonds. However, there are certain important differences between them. First, Sukuk means ownership of an asset, while bonds reflect a debt obligation. Secondly, Sukuk assets are compliant with Sharia standards. In our previous lectures, we mentioned that all Islamic financial instruments are reviewed by Sharia committees, which are present in every Islamic bank or financial institution. If we talk about conventional bonds, there is no such requirement to be Sharia-friendly. Thirdly, the price of Sukuk is based on the value of underlying assets, whereas the price of a conventional bond is based on the credit rating and some other factors. Fourthly, the price of Sukuk can increase when the underlying assets increase in value. Profits from bonds correspond to fixed interest, making them riba, which is prohibited in Islam. As far as similarities are concerned, both Sukuk and bonds can be sold on the secondary market, so that the holder can get cash if he wants to. Also, both bonds and Sukuk can have corresponding ranking based on companies' financial and business performance. These days, investors can find different types of Sukuk based on the different structures of Islamic financial contracts, whether it is Ijara, Mudaraba, Murabaha or Istisna, depending on the project that the Sukuk is financing. Overall, Sukuk market is set to grow in future as large companies and sovereign governments are trying to finance their ambitious projects, while institutional and private investors are willing to diversify their investment portfolios. Islamic finance industry has been developing very quickly over the past decades and has come up with many sophisticated financial products that both meet Sharia standards and meet customers' expectations in terms of proper investing, saving their money, or mitigating financial risks. One of the most popular financial services these days is insurance, whether it is car, house or life insurance, and Islamic finance also offers its Sharia-compliant insurance services known as takaful. The word takaful is derived from the Arabic verb kafala, which simply means to take care of one's need. Actually, insurance in Islamic countries has existed for quite a few centuries. It is known that medieval Arabic sailors used to insure their vessels and goods during their sea voyages while trading with other countries by sea. Modern Islamic insurance developed in 1970s when Sudanese Sharia scholars prepared theoretical basis to reconcile Sharia and insurance via the scheme when donations from individual members had to be paid to a mutual fund, from which the claims could be paid afterwards. These donations are commonly known and called as tabarru in Arabic. Later on in 1979, the Islamic Insurance Company of Sudan was established, which was the first modern Islamic insurance company using takaful scheme. In the next decades, takaful companies opened in ASEAN countries, primarily in Malaysia, Brunei and Indonesia. This was followed by Gulf countries, and later on even some Western countries started to offer takaful insurance services. Today, takaful market is approximately estimated at $20 billion as for 2018 and is projected to double in the next 5 years. So, why did the Islamic countries decide to create their own insurance schemes? The thing is that, as we already know from our previous episodes in this course, there are some basic rules in Sharia which have to apply to all Islamic financial products and services. Conventional Western type of insurance has certain features which are not Sharia compliant. Let's have a closer look at conventional insurance before we dive into takaful. In conventional insurance, policyholders pay a premium in exchange for a payout to them in case their car has an accident, their house is damaged, or they happen to have an injury, or even in case of death of the policyholder. Insurance covers a certain time period, and in case none of the situations mentioned above happen and the policyholder has nothing to claim, the premiums remain with the insurance company. Usually, insurance companies invest the premiums into interest-bearing investments, such as banking deposits or government or corporate debt obligations. And this is riba, or interest, and riba is forbidden in Islamic finance. This is number one why conventional insurance is not Sharia compliant. It is also mentioned in the contract that the insurance company, in case of claim from the part of the policyholder, will have to pay the amount far larger than the premium paid, which is also deemed as profiting from the money directly, which is also forbidden in Sharia. The second point which makes conventional insurance not Sharia compliant is gharar, or uncertainty. In insurance, it is unknown either the insurer will gain if no claim is made, or the policyholder will receive a great amount of money although he had paid much less. This level of uncertainty is ethically unacceptable in Sharia. Another point which is similar to gharar is qimar, or inequality. Here one party gains at the expense of the other, which contradicts to Sharia principles of shared risk, responsibility and gain. Now let's have a look at how the takaful insurance works in more detail. First of all, it is worth mentioning that takaful insurance, like any other Islamic financial products, can be used by any person regardless of his or her religion. So, if a person wants to insure his car, house or his life, he comes to the takaful company and makes a contribution to a mutual fund or pool instead of paying a premium. The amount of contribution that each participant makes is based on the type of coverage they require and their personal circumstances. As in conventional insurance, a takaful contract specifies the nature of the risk and time period of coverage. The contributions received by the takaful company are split into three parts. The majority is paid into what's called waqf, or it can also be called takaful fund, which is the joint pool from which the claims of all members are paid. Part of this money pool, usually about 25%, is considered as a donation. You are paying voluntarily to provide aid to another policyholder without recompense. It means that all policyholders within this takaful fund agree to guarantee each other in case a risk occurs with one of the members. It also means that you can also claim from this pool if needed. This part of the takaful fund is what can be called the protection part. The rest of the pool then goes to an investment structure managed by the takaful operator. The third part is paid as a fixed management fee to the takaful operator, and in this case the takaful scheme is called wakala. We are going to look at different takaful schemes a bit later in this episode. So, apart from policyholders' claims, which they receive from the protection pool, policyholders also get financial benefits from their participation in two ways. They receive a share of the profits from the investment proceeds either during or at the end of their policy term. Second, the net rest of the underwriting surplus. That means that if during policy term the amount of money used to cover the claims on the unfortunate policyholders was less than the underwritten pool of premiums, then this difference will be distributed between the policyholders. And of course, nothing will be paid additionally if there is an underwriting loss, when the amount of claims was larger than the combined donations. So this is another significant difference between conventional insurance and takaful. In conventional insurance, if there is surplus at the end of the term and profit from the investments made, then all this additional money will go to insurance company. In contrast, in takaful, all surplus and profits from the investment will be distributed between policyholders. It means part of their money will be given back to them. So, what else should be noted? Well, for the takaful operator to start working, it needs some initial investment for startup, administrative and marketing operations, just like any other startup would need. And this money is needed before they start to attract policyholders' premiums. So the takaful company must have its own fund created with shareholders' capital. This fund is also called operating fund. As mentioned, the shareholder fund, made from paid-up capital, pays for company's administrative expenses. It must be completely separate from the takaful fund, which is formed with the premiums paid by policyholders. If takaful operator experiences a deficit during its operations, it cannot take money from the takaful fund. Instead, the takaful operator shareholders will usually provide an interest-free loan to the company, commonly known as Qard Hasan. And when the deficit disappears and the surplus accrues, the shareholders will deduct the loan amount from the operating fund surpluses. We mentioned that there may be different takaful schemes. So the first one is called wakala, or agent model, when the takaful operator receives fixed management fee for managing the takaful fund and investments. This model is more common in the Middle East. The second model is called Mudaraba scheme. In this model, takaful operator can be paid for its services by part of the profit from the investments made. The share of the profit is discussed before signing the takaful contract. Mudaraba model is more practiced in Asia. There is also the third scenario, when takaful operator will take both a fixed management fee and share of the profit from the investments made. This is a hybrid scheme, which is also quite commonly used these days. So it seems we have covered takaful and how it works. Just to recap, let me show you a table which compares the traditional or conventional insurance based on premiums on the one hand and Islamic insurance or takaful on the other. In takaful, the contract is a combination of donations and agency or profit sharing contract between policyholders and the takaful company. In conventional insurance, this is an exchange contract, which is the sale and purchase of a policy between insurance company and the policyholder. Takaful operator is only the fund manager. Participants mutually guarantee each other. In conventional insurance, the insurance company provides all the guarantees. In takaful, the contributions belong to participants, but they are managed by the takaful operator. This takaful fund is separated from the company's shareholders' fund. In conventional insurance, all the collected premiums belong to the insurance company. In takaful, all the claims arised by the policyholders are payable from the takaful fund. In conventional insurance, all the claims are payable by the insurance company itself. In takaful, risk is shared among all the participants, while in conventional insurance, risk is transferred from the policyholder to the insurance company, which bears all the risks. In takaful, assets of the takaful funds are invested only in Sharia-compliant instruments, and all the profits from these investments belong to and distributed among policyholders only. In conventional insurance, there is no restriction on where to invest apart from those imposed for prudential reasons. All the profits from the investments belong to insurance company. In takaful, in case of surplus, when the amount collected by the contributions is more than the claims were made, then this surplus is distributed between participants only. The operator cannot claim any of the surplus amount. In conventional insurance, the surplus belongs to insurance company. It is considered as profit when the claims are less than the premiums. In case of deficit, in takaful, Qard Hasan or interest-free loan is given to the takaful fund. In conventional insurance, if there is a deficit, it is financed from shareholders' fund, that is by insurance company itself. Sharia supervision is an integral part of any takaful setup, and in conventional insurance there is no Sharia supervision. So what can be said about takaful is that it is definitely worth exploring when choosing between various types of insurances. It works differently from conventional insurance, but the basic idea that you make payments and then receive payment when in need is common for both. Takaful offers a clearer ethical perspective than normal insurance, as all the surplus and profits from the investments go back to participants or policyholders and not to the insurance company. Sharia law allows investing in company stocks and shares, but only in those companies that comply with Sharia principles. Of course, companies which are located in Islamic countries where Sharia is the official legislation, such companies automatically qualify for these criteria. However, what should Muslim investors do if they want to invest in foreign companies located in other jurisdictions, for example in Europe or the USA? Which company can be investable from a Sharia compliance perspective? Therefore, in order to understand whether investing in a company would be Sharia compliant or not, Islamic scholars and Islamic financial organizations have come up with two types of screening, which define whether a company can be investable from a Sharia compliance perspective. The first type of screening is for the business activity. We already mentioned in the previous lectures that the prohibited business activities include lending with interest, gambling, alcohol, tobacco and pork production, and weaponry. So, any company whose main business includes these activities cannot be considered as a proper investment. However, we know that these days most companies use interest-bearing debt financing, which is prohibited by Sharia. That's why Islamic scholars have come up with certain concessions or second type of filters, which is financial screening. The broadest set of filters excludes companies that hold interest-bearing debt, receive interest, or trade debts for more than their face values. So, traditional banks which use these instruments as their core business certainly do not meet these criteria. The next and more strict set of filters excludes companies whose debt to total asset ratio equals or more than 33%, companies whose interest-based income and other non-compliant sources of revenue equal or more than 5%, and companies whose accounts receivable and cash are more than 50% of total assets. I think most of these criteria are easy to understand, but what's wrong in having too much cash on the company? Well, the argument is that if the proportion of cash and cash equivalents in the company's bank account is too large in relation to the total assets, say more than 50%, it means that when you buy or sell the company's shares, then you are essentially buying or selling money, because this is basically what the company consists of. And we know that buying and selling money at different prices is called riba and is prohibited in Islamic finance. So, even if the company's core business is permissible, but too large a ratio of its income comes from interest, then the company will not be eligible for investment by Islamic investors. Here's an example. Imagine that we have a company which makes and sells Christmas and New Year products. Company's business is obviously very seasonal, and by the end of the year, they have large surplus cash which they decide to invest in interest-bearing money market, for example some bank deposits or bonds. If the income from the interest that they will get will represent a significant part of their total income, then the company will not be eligible for investment from Sharia perspective, even though their core business is permissible. Another example is with real estate developers that use considerable debt financing in the form of loans and credits for construction. So even though real estate development itself is Sharia compliant, but if the company uses too much interest-bearing debt, then it will be excluded from Sharia compliant investment. Since individuals cannot always screen thousands of companies out there on stock markets to understand whether they can be investable from a Sharia perspective and whether or not they meet the above-mentioned screening criteria, major global players on stock market have developed their special Islamic indices that monitor which companies comply with the Sharia principles. These indices include indices by Accounting and Auditing Organization for the Islamic Financial Institutions, commonly known as IOFI, the FTSE Global Equity Sharia Index Series, the Dow Jones Islamic Market World Index, S&P Sharia Indices, and the Russell Ideal Ratings Islamic Index. These indices may have slight variations in the methodology for screening stocks to be Sharia compliant, but all of them filter the stocks and companies for business activities compliance and financial ratios. That's why individuals or mutual funds that want to invest in Sharia compliant companies may use either of these indices to select the appropriate stocks. As you can see, Islamic finance is not very much different from conventional banking. It has the same goals as to provide financial assistance to companies and individuals while making profits for the Islamic banks, since Islamic banks are commercial institutions like any other commercial companies. What is different is the way the financial transactions are structured in Islamic financial institutions. Instead of loan and interest agreements, which are prohibited in Islamic finance, Islamic banks rely mostly on sales and profits and loss sharing contracts. In this regard, unlike conventional banks, Islamic banks are usually regarded as trade houses or investment banks. Having emerged in the second half of the 20th century and relying on the principles set up in the Quran and Sunnah of the Prophet Muhammad, Islamic financial institutions have been growing at a spectacular rate of 10 to 20% annually. Nowadays, more and more Western financial institutions provide Islamic financial windows or products, which proves that Islamic finance can be a valuable pillar of the world financial system. With this in mind, we believe that Islamic finance is worth studying, and we hope that you enjoyed this short course. Please let us know if this course has been useful for you and if you learned valuable information. Do you want us to explain other financial instruments or other details of Islamic banking and finance? Shall we continue expanding this course? We would really very much appreciate if you could leave your review for this course so that we could make it even better. We would also like to thank the Waqf Fund Russia for making this course possible. Hope to see you in the next courses.